high yield debt is quite important at the moment to help you solve where you are going to find distribution and income in a very low interest rate environment where your term deposits may not be as attractive as they used to be. And also with COVID, you have discovered that companies may have to stop their dividend, and a very high portion of income for people coming from dividend has been a bit more volatile. Whereas in high yield, it's a contractual obligation from the corporate to pay their coupon, like on any debt. So I think it's actually very important at the moment to consider that. Obviously, you have to consider it within your portfolio, manage the risk properly, but it's interesting, and very often people have to have recourse to fund or trust, as we have, to access that sort of debt, because it has been really the realm of institution being able to invest in it, and it's still the case. So the trust gives you the ability to go and invest in it. It's a good opportunity because there will be quite a bit of choice, because there is business confidence, there will be merger and acquisition and growing companies will need some capital, and therefore there will be more high yield debt issued. So it's going to be very interesting. But also for investors in the portfolio at the moment, the portfolio is quite well set up. By that I mean that we can meet the objective of the portfolio. Therefore, we don't have pressure to, take whatever is coming on the market. And we never, feel under pressure. It's a good thing. We are quite disciplined. We do it with high conviction. And we often turn down 75% of what we look at. Depends on the appetite. Yeah, it means you have to look at a lot of things. But that's important. There are things which we think would not be having a sufficient track record for us to enter into. It's too early. We like to have established companies. It's some of it is the structure. We are not going to like the rights. We like to have strong rights so that if things don't go as well as we thought, we'll still be made good where we sit in the capital structure, and that's because, if it's high yield, but it's fixed income, so there is to be capital stability. So you have to be making sure you're happy with that. So it's a number of things, so you just constantly talk to people, and there are things you like and things you don't like, but that's fine, and we always put our objective with, we know that we won't do as many things as what the market gives us. And we can be selective. For high yield, one of the main risks is really the risk that a borrower doesn't repay you. So how do you look at this risk? Really, it's all about doing very good research, and we have a very strong process on that. We looked in details at companies. We where do we sit in the capital structure? We like to be at the high part of the capital structure. So if a company was having problem, in simple terms, we have the first dollar back, was as equity you are at what we call the bottom of the capital structure. So we like to be there. We like to make sure our terms are okay. And so the legal documentation review is important. And another thing where we spend a lot of time is looking at the valuation of those business, and through the cycle, where do you think that value would be, and make sure that for the debt that we lend, and that high yield piece of debt has actually very strong security in a way through that valuation. So that's a very important part of the work that we do. You meet management. You do all of your ongoing research as well to make sure everything is going well, and along the life of this asset you are happy to continue to hold it. But there is also an important part, which is to have experience and to have looked at those assets for a long time. Personally, I've been looking at that for over 20 years in London and here, and I've looked at high yield companies, but I've looked also at a lot of distressed debt companies, and that's a great angle because when you look at distressed debt, you look at companies which have had difficulties, which have had issues from time to time, structure, and all that learning is so important to make sure you invest with high conviction. You know where the problem have been in the sector of that industry, and you know what are the structural problem in documentation that you don't want to have. So, you know, a mix of that makes that we invest with high conviction, and the portfolio has done quite well through COVID, which was, you know, such a stressful experience economically. So we are quite happy. Well, I think people would be familiar, for instance, with a company called NextDC that we have invested for several years and months for PCIT. They have just exited the high yield market because they have managed to get a better deal with banks, and that's part of growing up. But that shows you it's a typical growing company which needed fund and has been 6 years in this market and has had a very good experience. It's been very good for investors, and it has been key for them to grow and have another pocket of money to grow aside from equity and the normal bank market. That's very important because what you want is to have a portfolio which is very resilient. And so to have resilience, you don't want all your eggs in one basket. So you really want to invest in different type of structures. So we do loans, high yield bonds, and we do also a little bit of RMBS, or mortgage securities. So you want to mix the structure, but you want to really mix also the sectors so that, you know, if there is economical problem in one sector, other sectors are doing well. You want to mix the maturity of your portfolio and do a number of things, which mean that, you know, you have a diverse portfolio, and if you were unlucky with one company having a problem, it has a very, very small impact on your portfolio. So diversity is really an important tool to manage your risk. So in the PCIT portfolio as a whole, it's around 46%. 60% or so would be unrated, whereas 40% is sub-investment grade. And of that 46%, 10% would be RMBS type security or mortgage securities. So the rest are loan and bonds. Unrated is a very Australian thing. And that's because the Australian market is a small market in the end. And companies tend to be smaller than their offshore peers. And therefore, companies which may be quite well managed and have good financial metrics would not have a sufficient size in terms of turnover, for instance, to pretend to an investment grade rating. So they prefer not to go for a rating process and stay unrated rather than have the sub-investment grade. Other companies are very comfortable with that, and they may want to have offshore capital as well as Australian capital, and they will go for the sub-investment grade, for instance. So if we think, you know, about companies people may be familiar with, Moal, for instance, has a sub-investment grade rating, whereas a company like Centuria is unrated, for instance, or NextDC was unrated. Well, hopefully we do quite well because through COVID, we haven't had losers, which is very important. What I mean by that is we haven't had default in the portfolio. We haven't had restructuring. We haven't had delayed payment. So the portfolio has done very well and has been very resilient. So that comes back to the process. You know, you have a good bottom-up research process. You access a lot of information, especially if you are doing a private deal, so a loan typically. You will have a lot of information that other on the public side you would not be privy to. So that really helps you to develop that high conviction. And the experience is coming back as well, to have seen sectors, to know that some sectors are more volatile than others. And it's also, you look and spend a lot of time on the management, who are the equity sponsors, and how you think they would be supportive of this asset in time of crisis. And I think we have done a very good call. We have had very good sponsors to make sure that their corporates could do well through the difficult time of COVID, when that was the case. I think at the beginning we really pay attention to volatility, because if you think you are going to enter for 3, 5, 7 years, you really want to make sure that, if you're at the trough of the cycle in 3 years, you'd be happy. So it's not that we are moving so much the portfolio, it'd be really something that we would not be that tolerant. So there are a lot of sectors would be very careful. And if we think they are more volatile, we would want that they have good attribute to them. So they are carrying a lot of cash. They are well aligned with their market. So I'm thinking of mineral resources, for instance, which is in a more volatile commodity sector. And we try to have that as a part of the portfolio, which is not very big, so that it's smooth. But really we try to make sure that we think the asset we have can withstand a lot of volatility, because you don't know what life is and what the economic cycle would be at 2 or 3 years from now. Nobody knew there would be a pandemic in late 2019. So. Yes, I think there will be strong demand, there will be a recovery. So we have already seen in the portfolio few of the companies which have been a little bit affected really have bounced back very, very well above what we thought. And that shows they were good companies, and could take a couple of months a bit harder and with some uncertainty, but I think it's very exciting, and it will be a very good period. But you have always to think that your debt may be longer than the next year or 18 months, so you have also to think how will they do when things are not as good.